The following audio recording has been designed for learning purposes only. Do not share, distribute, or provide any type of copies, or this audio lesson will not be made available to you. Good luck with today's lesson.
Hope everyone's doing well today. What we're going to cover is we're going to move over to part 4 of the textbook, and we are going to focus on chapters 40 through 45 and 47. Today's discussion is actually going to deal with chapter 40, types of business organizations. So let's talk about those business organizations. There are 3 main types of business organizations that have been around for a long time. They're the principal forms of business organizations, and each of these forms will have various advantages and disadvantages. So what are those organizations? They were sole proprietorships, partnerships, and corporations. Now, if one is deciding on how to organize his business, he should consider various issues, such as personal liability, management, ease of transferability, taxation, and liquidation. So let's talk about each of these organizations. What is a corporation? A corporation is going to be a fictitious being. It's independent of its owners. The corporation can either sue or be sued, and it can conduct business in its own name. Sole proprietorships. What's a sole proprietorship? This is a business that is owned by one person, who may be the only worker of the business, or he may employ as many workers as are needed to run the business. And our partnerships? The partnership is going to be an association of 2 or more people whose goal is to make a profit. The partnership will have 2 elements, community of interest and sharing of profits. Now, partnerships are going to be different from agencies in that partnerships have co-owners. In addition, partnerships are going to be different from joint ventures and unincorporated associations, and we'll talk about those differences later. Let's look at some of the following examples. So our first example, we have Bill and Ted. And after their excellent adventure, Bill and Ted decide that they want to open up a travel agency. So what are they going to do? They're going to call it Bill and Ted's Excellent Adventures. They decide that this business should be operated as a corporation. So they go and they draw up their articles of incorporation and they put them in the company's safe deposit box. They carry on this business as a corporation, and they even put the word Inc. after the business name, and they keep company records and finances separate from their own. The question becomes, is this travel agency really a corporation? No, it's a partnership, because the articles of incorporation were never filed with the Secretary of State as required by law, and thus Bill and Ted will have a partnership. Filing is going to be the principal difference in formation between a partnership and a corporation. Let's look at the second example, Curly. Curly happens to own shares in the Yuck Yuck Wise Guys. It's a Major League Baseball team, and Curly becomes disgusted with the whole business of baseball when the team makes a $250 million 7-year deal with a free agent, Mr. Costello. Without telling the other owners, Mo and Larry, Curly goes and transfers his interest in the team to Shemp. Is Curly's interest in the corporation transferable? Doesn't matter whether that team is a partnership or a corporation. Here it is going to make a difference, because if it's a partnership, Shemp isn't going to be an owner. However, if it's a corporation, he probably is. The last example we'll look at is Monica and Phoebe. Monica and Phoebe happen to own a catering business. The Roast of Friends, Inc. They each own 50% of the shares. Phoebe happens to die in a freak accident when one of the corporation's employees, Janice, drops a hunch of venison on her. Since Phoebe owns 50% of the corporation, will that corporation terminate along with her? Here, no. Corporate existence will not depend in any way on its shareholders, and as a result, the death, withdrawal, or bankruptcy of any shareholder will not terminate the corporation. Now let's go and look at the advantages and disadvantages of each of these different forms of business organization. As you can see by the chart, I've kind of detailed out for you the 3 main organizations we've been talking about: sole proprietorship, partnership, and corporations. So what's really the advantage of each, and what's the disadvantage? If you look at a sole proprietorship, it's great because you're the only owner. You're going to get taxed at a personal income. There's really no fees that you have to pay for organizing the business, and you basically get to keep all the profits and the losses. But what's the major drawback? You're subject to unlimited personal liability, which means that they can come after all your personal assets and you could lose everything you own. The other thing is you're limited in what your resources are. So if you only have $5,000 to put towards that business, that's the only capital you're going to have. And the last thing that's really a disadvantage is once you die, the business is going to terminate upon your death. Let's assume though now you want to pool with somebody and get more money and have a bigger resource. This is where a partnership could come in. Here the advantage is, again, you'll pool the money, you'll have 2 or more people, and there's really no formal organization structure. But like sole proprietorships, you're subject to that unlimited personal liability, and this too will terminate upon a partner's death. And it will be difficult to transfer. Finally, we come to corporations. Why would we want to incorporate? Because here it's a separate legal entity. It can be sued or be sued. It has perpetual life. And it's going to be easier to transfer upon someone's death. Also, you're going to be limited to your investment, which means you have limited liability, unlike proprietorships and partnerships where you had unlimited liability. But what's the biggest drawback to a corporation? Double taxation, because the corporation already pays a corporate tax rate, and then any shareholder might pay on the personal income they get upon distributions. You also have to file documents and pay fees. Now, what has become of this is we've had limited liability corporations, also known as LLCs, limited liability partnerships known as LLPs, and they have become more popular because they will enjoy the advantages without personal liability exposure to the partners. There are also specialized forms of business organizations that we'll talk about. These will include joint ventures, cooperatives, unincorporated associations, and franchises. So what are joint ventures? Joint ventures are going to be relationships between 2 or more persons who will combine. And what they'll do is they will combine their labor or property for a single business purpose. And then they will equally share losses and profits unless they agree differently. Now, cooperatives are going to be a little bit different because this is where you have 2 or more persons, but they're going to cooperate for a common function or objectives. And then the last organization we might have is an unincorporated association. And now unincorporated associations are not necessarily business organizations, but they're where you'll have 2 or more persons joining together for a common purpose. And the parties to that unincorporated association may have individual liability. Here I've kind of detailed the chart for you of what I've just described, the joint ventures, the cooperatives, and the unincorporated associations. And if you look, I tried to detail out what are their characteristics of each, but I wanted to show you how they're different from a partnership. And as you can see, the unincorporated association is going to be different from the partnership because they're joining for a nonprofit purpose, whereas the partnership is joining for a profit. And it differs from joint ventures because the joint ventures is for a single business transaction and is terminable at will, while a partnership will actually continue until it ceases to exist. Each of these specialized forms of doing business also has advantages and disadvantages as well as specific requirements for the formation and operation. The last business format we're going to discuss in this chapter is franchises. So what is franchising? Franchising is a method of doing business. The parties in a franchise are known as the franchisor and the franchisee. There are 3 types of franchises, and they are manufacturing or processing franchise, a service franchise, or a distribution franchise. What's the distinction between these? Manufacturing or processing franchises, this is where the franchisor grants the franchisee the authority to manufacture and sell products under the trademarks of the franchisor. A service franchise is where the franchisee renders a service to customers under the terms of the franchise agreement. While distribution franchise, this is where the franchisor's products are sold to a franchisee who then resells them to customers in a geographical area. The franchise format is for business is one in which the franchisor grants the franchise the right to use a trademark, trade name, or copyright license in a business. Franchise disclosures and agreements are going to be heavily regulated by the FTC, and the franchisors can incur liability for activities by franchisees. But generally what will happen is the franchisor is not liable for harm caused to third parties. The franchisee is going to be liable though for his torts and contracts with third parties. So let's look at the disclosure requirements that you need to include. And these are also listed for you on page 831 of your textbook. They involve business experience of the franchisor and brokers, any current and past litigation against the franchisor, any previous bankruptcy, material terms of the franchise agreement, initial and recurring payments, restrictions on territories and grounds for termination, and the last one is actual, average, or projected sales, profits, or earnings. If the franchisor violates the disclosure rule, he could be liable for civil penalties. We've now covered Chapter 40 in a nutshell. Please let me know if you have any questions after listening to this audio.
Good luck with today's lesson.